Good afternoon and welcome to the Asian Midday Market Watch, powered by Al Rajhi Bank Malaysia. Kelvin Wong, market strategist at CMC Markets, is our guest today. Kelvin, thanks for coming in.
Hey, thank you, Brian. My pleasure to be back.
Now, Kelvin, before we get your insights, let's first take a look at how crypto markets are performing, and then we'll take a look at regional stock markets. Bitcoin is now at 43,369. It's down 4.37%. Ethereum is at 3,198.92. It's down 0.79%. Now, looking across to regional stock markets, we start close to home with the SGX. That's at 3,404.06. It's down 0.55%. Now, looking across to other markets in the region, we've got the KLSE, which is at 1,602.37. It's down 0.15%. Now, Shanghai is at 3,246.05. It's down 1.14%. The ASX All Ordinaries is at 7,736.8. It's down 0.66%. The Nikkei is at 26,931.5. It's down 1.53%. The Hang Seng is at 21,773.5. It's down 1.39%. And rounding up the numbers, we've got the Kospi, which is at 2,700.1. It's down 1.27%. Now, Kelvin, it's a sea of red today. Tell us why.
Yes, typically what we are experiencing right now is kind of a negative feedback loop from the major US benchmark stock market, where since the start of Tuesday, we start to see two consecutive down days on the US benchmark stock market. So apparently, especially the worst hit is actually growth-related stocks, like we talk about tech company and as well as small cap related stocks. There are more these two companies, why they are being actually kind of a main culprit that actually drag the US stock market down is to their reliance on leverage or borrowing to actually drive revenue and their bottom line. So what we could see over here in the last couple of days, what we have is that we have a kind of not a confirmation, a reinforcement that the Fed is going to actually start a quantitative tightening. That means we're talking about withdrawing their massive or unwinding the 13 of plus over year of accumulated bond portfolio of bonds holdings, which is worth 9 trillion. And what they actually pencil in for May is that the quantum or the pace of tightening is much more faster in terms of potentially in terms of the magnitude and as well as the absolute amount that they want to reduce by per month. Much more higher compared to the previous tightening by Powell and his gang during 2017 and 2019 before the US-China trade war. So that causes a spark of what I call this kind of a short-term negative feedback look into the ASEAN stock market today.
And we're looking at about $95 billion pullback, isn't it?
Yes. So that's a tremendous high amount. Talking about given that the markets are kind of accustomed to this high level of liquidity that's being pumped into the market in the last 13 over years since the great financial crisis of 2008 and 2009 year.
Now, Kelvin, how is that going to impact rates then overall? How is that inverted yield curve looking like?
So before I talk about the inverted yield curve, right? So definitely there will be a inverted. The yield curve inverting across the across the spectrum will be there's a higher probability. So even though the 210 yesterday managed to go back slightly to positive territory, but I believe that's more short-term in nature. So the reason why is let us take a look at this chart. Okay, so this chart is a very important chart for the financial markets. Why is actually the US 10-year Treasury yield? So why is it important? Because the US 10-year Treasury, take it as a sign that it's a global risk-free rate. So being a global risk-free rate, so it being used as a benchmark to actually price financial assets or financial products such as our mortgages and even corporate loans, depending on whether you are what you call a investment grade company or a what you call a non-investment grade company. They will use the Treasury 10-year Treasury yield to price it. So what we could see over here is that in the last 40 years or so, since September 1981, it's been in a very circular downtrend. That means we're talking about interest rate has been coming down. So especially in the last 13 years, where everyone is so accustomed to low interest rate that people start to actually be placing a lot of emphasis on on bonds, hoping to actually get a capital return because interest rate is so low. But now the big question over here is that in the last couple of days or weeks, I would say it starts to actually shape a very dramatic push up since the low of September last year, and it exacerbated in last month. And in fact, right now, right, it's actually attempting to break this key resistance of 2.55% over here. So right now it's actually trading at 2.58%. So if this week, right, if we can have a very strong bullish candle and a weekly candle and a weekly close over 2.5%, there's a high chance that we will start to see the end of this 40-year downtrend in US 10-year Treasury rate, which i.e. it could actually potentially lead to a rapid pace of interest rate increase in the yield to 4% and 5.2%. So that could actually translate right down to what I call a potential rapid pace of higher cost of funding for corporates getting loan, for corporates who wants to actually borrow in the bond market, and even for us if we want to actually refinance our housing. So we might start to feel the pinch when they start to come into the real economy. So that definitely will actually kind of a slow down growth in from a long-term perspective here. And especially you talk about market. Yeah. So very quickly, you talk about markets, right? What you can see at the bottom of my chart, right, is what I did is I did a ratio on the Russell 2000 versus the SPX, which is the main benchmark index. So we could see that this ratio is actually inching downward, and the dramatic fall has actually took shape right exactly where the 10-year Treasury yield start to spike up in August and September last year. All right, so we could see for shares obviously that we start to see this underperformance of US small caps versus the benchmark index, where you know that small caps like game stocks or all these kind of meme stocks that actually more reliant on leverage to actually drive their growth here, where we actually get impacted negatively here.
Now, Kelvin, I want to take a look now at oil markets because the IEA coordinated release announcement yesterday. Tell us more about it.
Sure. So maybe let's talk about this IEA. What is it about first? So this IEA is actually a map. It's constituted of several countries who are actually importers of oil. So that including US, UK, and Japan. All right. So they actually released 120 coordinated so-called we call it additional oil supply to the market. But a portion of it, which is 60 of it, actually is included in the announcement last week, where US itself solely wanted to release that 180 million barrels in total. So for US, right, is they want to release 1 million barrels per day for the next 6 months. You see, so all in all, right, the markets also or they only see a release of 60. So 60 plus 180, right? Right now we see an additional supply of 240 million barrels for oil that's coming to the market supply. So
over that 6-month period.
Yeah, so that amount is actually not that huge, not that significant at all. But now the problem with the situation right now is that because coupled with the COVID lockdown situation in China, especially on important hub of China, the commerce hub in Shanghai, that is now extending beyond the 8 days. So initially they're talking about talking about this week they should actually resume back to normal operation like what Shenzhen did. But it seems to me that it seems to us that based on that the cases are rising on the upside, and this lockdown will start to extend, and who knows, it will start to extend another 1 week or 2 weeks or even a month or so. Okay, there's no clear indication that when it will stop. Okay, so right now because of this situation being brought into the picture of the oil market, so it actually causes a bit of near-term we call it negative sentiment that actually hit the oil markets. You see, so that's why right now what we see is that short-term speculators, right, are slowly unwinding those guys who actually came later in the picture, I said 2 weeks ago, they're slowly unwinding their long position that causes this dramatic fall on the oil price in the short term of 5% yesterday. And because of that, they kind of broke down a key medium-term technical level. Like I'll share the chart with you all. So this chart, I think, we shared last week. So previously, we are looking at this 9840 level, which is actually the 50-day moving average, as well as this ascending channel, medium-term ascending channel from the low of December last year. Okay, December last year. So it's been trending very nicely upwards. So this is why I call it a medium-term trend. So yesterday, price action, right, actually broke this medium-term trend. So what we could see now, potentially, right, in terms of sentiment, it has started to turn bearish, at least in the short to medium term. So potentially, right, if the oil prices can't do a daily close above around 106 level per barrel, we could see this short-term sentiment and medium-term sentiment persist into the market, and it could take it down towards the next support level at 84.65, which is so close to this 200-day moving average as well. So that's the next key technical level to watch. So basically, 106 level, it can't surpass above. There's a big risk that we start to see this we call it multi-week potential corrective pullback to retrace this very short major uptrend in oil price that we see in the last 2 years or so towards the next support at 84.65.
Now, Kelvin, as always, thank you very much for your insights and thank you very much for coming on the show.
My pleasure, Brian.
Now, I'm Brian Fernandez, and we've been speaking to Kelvin Wong, market strategist at CMC Markets, on Biztech's Asian Midday Market Watch, powered by Al Rajhi Bank Malaysia. This video and podcast will be on our website, www.biztech.asia, as well as Al Rajhi Bank's social media platforms. Please like and subscribe to our various platforms. Thank you very much for tuning in.